Do you want to know how to invest in ETFs, exchange traded funds? Then you want to stick around till the end of today's conversation. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous if you're to ask me. And if you are doing as great as I am, grab a cup of coffee or tea or vodka and let's roll. Today I want to have a conversation around ETFs, exchange traded funds. Those are another category of assets that you need to think about when you are pondering diversification, when you want to diversify your investment portfolio. And today I'm going to the nitty-gritty here. While trading individual stocks is often the focus when people mention investing, the reality is that you can have better luck if you use exchange traded funds as part of your investment strategy. Not just ETFs, you have other asset classes. I'm talking about bonds, ETFs, of course, mutual funds, alternative assets, commodities, and so on and so forth. But today we were just talking about ETF. When you invest in an ETF, you get the benefit of instant diversification in an easy to trade package. Depending on your situation, an ETF investments can be an excellent way to build a portfolio that is relatively easy to manage, especially when you think about 40 years, 20 years, 30 years, when you're thinking about retirement. That's very important now. And today I want to talk to you, in today's video, I want to talk to you about what an ETF is, how to invest in an ETF, what to look for in an ETF. I'm going to also have a conversation around different types of exchange traded funds, the pros and cons of ETF investments, the risks of ETF investments, and also I want to have a short conversation around how ETFs can help you build up your portfolio, how you can optimize your return on investment, your ROI, by embedding ETFs in your portfolio. First thing first, what is an ETF? An exchange traded fund is a type of investment fund that trades like a stock. Simple as that. So you can buy and sell ETFs on the same exchanges as shares of stock, most commonly the New York Stock Exchange and NASDAQ. So like mutual funds, a single purchase can give you access to a diverse base of underlying assets. With an S&P 500 index ETF, for example, buying a single share gives you exposure to all the 500 stocks at once. So that makes ETFs a great tool for new investors who don't have the assets to build a diverse portfolio on their own. So each ETF has a name and ticker symbol. So using that ticker, you can trade during market hours from 9:30 to 4:30 to 4 o'clock if you're buying on the New York Stock Exchange. And the biggest and oldest ETF is the SPDR S&P 500 from State Street Global Advisors. And this is also called the SPDR, and the ticker is SPY, the SPY. It holds a massive, check this out, $300 billion in assets. All ETFs together hold almost $6.2 trillion in assets. That compares to 21.3 trillion held in mutual funds. So now you kind of have an idea of what we're talking about, the size of the assets we're talking about. This is colossal, right? So now that you understand what an ETF is, how to invest in an ETF, you have to do a few things. First, you have to open a brokerage account. So an ETF investment is fairly straightforward. You can invest in an ETF through just any broker because they have ticker symbols or they are traded like stocks on the exchange. So you can open a brokerage account either with a robo-advisor or with a broker account like TD Ameritrade, Charles Schwab, Robinhood, and so on and so forth, the Fidelity Investment, Franklin Templeton. Number two, pay attention to the fees. When investing in ETFs, it is very important to understand how the fees work. There are two main fees you need to know about. Transaction fees, aka commissions. Just as you might pay a fee when you trade a stock, you might pay a fee when you trade an ETF. However, many brokers, including Robinhood, Schwab, and others, no longer charge transaction fees. Even if a broker charges a transaction fee for stocks, there could be a selection of ETFs that don't have fees. So besides transaction fees, you have expense ratios. So like mutual funds, ETFs have expense ratios. However, most ETFs have low ratios such as 0.04% or 0.05%. So you want to look for ETFs that do the job for less and you keep more of your money. Third thing you need to do when investing in an ETF is to build a diversified ETF portfolio. So you want to make sure that you are diversifying your portfolio, especially if you rely on asset allocation. So choose ETFs that represent different asset classes. For instance, you could build a portfolio that focuses on stock and bond ETFs using a proportion that works for your timeline and goals, whether it is 60-40, so 60% in stock ETFs and 40% in bond ETF, or the reverse if you are in your 40s or 50s or pretty close to retirement. You want to keep adding to your ETF holdings. So, you when building a portfolio, consistency is key. It doesn't matter the amount, whether it is $100 or $50 every month. You want to keep adding. Many brokers allow you to set up an automatic investment plan, so you can set aside money each week or each month to be divided up as you wish. And the last thing you need to know is you want to learn the difference between ETFs and mutual funds. First of all, with a mutual fund investment, you own a portion of each investment in the fund. But when you buy an ETF, you are not actually buying a piece of each underlying share. Instead, you're buying a bundle called a creation unit that is put together by a financial services company. That's the first thing. Second thing is you can trade an ETF just like a stock throughout the day. So a regular market order suffices to buy and sell ETF shares. Mutual fund transactions, on the other hand, settle at the end of each trading day. Finally, there are another difference you need to understand when it comes to ETFs versus mutual funds is that with ETF investments, the capital gains and losses are fairly straightforward, and your tax liability is determined when you buy and sell. However, with mutual funds, you own the underlying assets and have to pay tax on the trades made within the funds. So if a fund manager sells an asset in the fund, you may have to pay a hefty short-term capital gains tax at the end of the year. I'll be right back right after this. Cool. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. We are still having a conversation today around how to invest in ETFs. And if you love the clarity and quality of the content so far, please consider subscribing to our channel and turn on the notification bell so you can be informed in real time whenever we drop a new show. And we drop this kind of shows, guess what, every single day, rain or shine. I want to talk to you now about what to look for in an ETF. Very important. There are a few things you want to look for. You want to look for low expenses, reliable tracking, very important, low or no commissions, low bid and ask spreads, and a known index. Don't try to buy something that is not known. So when it comes to low expenses, an exchange traded fund should be cheap to own. As an individual investor, you'll likely find ETFs attractive because of their low cost. Luckily for you, competition is holding down fees, so many investors find that they can get a better deal just by shopping around. So, for example, if you want exposure to the Russell 2000 index, there are two ETFs that track this index. So one from Vanguard has an expense ratio of 0.1%, whereas one from iShares charges 0.19%. So as both are essentially the same and liquid enough for individual investors, the one with the lower fee is an obvious choice. You want the ETF to have reliable tracking. So tracking errors happen when the ETF fails to keep pace with the underlying index. So this can happen for various reasons. So the underlying index constituents may be illiquid, such as the case in emerging market funds. The index may be impossible to replicate with an ETF. Remember that ETFs have diversification requirements that indexes may not have, and the fund itself is illiquid and does not move the same way as the underlying index. So you always want to compare an ETF's return for the past few years to the return of its underlying index. Make sure you have no low or no commission. If possible, always look for ETFs that you can invest in without paying a trading commission. This is important. So if you look at brokers like TD Ameritrade, Charles Schwab, or E-Trade, they offer a select list of zero commission ETFs that investor can buy. Same thing for low bid and ask spreads. So even if ETFs are not popular as of the day of today's show, make sure that you look for the ETFs with the lowest spreads. So these small funds trade sporadically, and they often attract so little interest that the ETF can go hours or even days without a single trade. So you don't want that. So and you also want to stick to a known index. So if you are a hands-off passive investor, you want to stick to a funds with a known index. I'm talking about S&P, Russell 2000. You have the S&P Small Cap 600 index is a well-known index, as is the S&P 500. So to drop down fees for investors, some fund companies are leaving well-known and understood indexes to use less tested and less researched indexes. You also want to pay attention to different types of exchange-traded funds. Let me kind of break it down. So ETFs come in broad categories, just like mutual funds, right? So major asset classes include equities, aka stocks, fixed income securities, bonds. You have commodities, money markets, precious metals, and real estate. There are ETFs focused on different regions, countries, market sectors, assets, and themes. There is an ETF for just about any investment plan or focus. So the choice there is kind of wide. So a large number of ETFs are index funds. So this means what? It means they can go up and down with major indexes like the Russell 3000, the S&P 500, or the Dow Jones Industrial Average. For example, let's say the S&P 500 goes up 2%. All S&P 500 index funds will go up the same 2%. ETFs can fill many different roles in your portfolio. For example, if you're looking to earn money from your portfolio, you could buy dividend and fixed income ETFs that make regular payments to shareholders. Very important. If you think the dollar is about to fall and gold will go up, there are gold and other precious metals ETFs. So if you're gung-ho on agriculture, for example, you could invest in a commodities or agriculture stock ETF. So the bottom line here is that with thousands of ETFs to choose from, it's very easy to allocate and diversify and customize your portfolio, folks. So it's also very easy to get lost with all the available options. So if that's the case, the first thing you want to do is that you always want to reach out to an expert, to an investment advisor, somebody who understands how the whole game is played, to have a better option, to have a better explanation. You can even contact a broker to learn more about the kind of exchange traded funds they have on their platform. Always educate yourself. I'm not, even if you have to contact somebody else to explain things to you, you want to do your own due diligence. You want to do your own homework to understand what you're getting yourself into, because guess what? At the end of the day, it's your money, it's your investment, it's your hard-earned cash. So you want to know where you're putting your cash. And knowing what you put in your cash is very important, because ETFs investments have risks and advantages. And let's talk about that. Let's talk about the pros and cons of ETF investments. Earlier I was just talking to you about hiring an investment advisor to guide you through the process. And that is if you have no knack for investing, no knack for financial education, and you are not interested or you don't have time for it. What are the pros of ETF investments? For the pros, instant diversification for your portfolio. The costs are low. It's easy to trade on the exchange, on an exchange such as the New York Stock Exchange or the NASDAQ. You have high liquidity, especially for the ETFs that are really known. You have low volatility, and you have fiscal efficiency. Those are the advantages of investing in exchange traded funds. What are the disadvantages? There could be potential trading commissions, especially if the ETF is illiquid, is not liquid. The trading commissions could go high. So you have a possibility of something called a contango, when ETFs don't stay in line with underlying assets. I will explain contango in a few minutes. And you don't actually own the underlying assets, unlike a mutual fund where you own the underlying asset. So with an index fund, with an ETF, you are actually just buying a paper asset, what I call a virtual asset. There's no asset, there's no property. So you're actually just making money on the capital gain and the dividends. Actually, there's no dividends. Actually, you're making money on the capital appreciation. If the ETF share price goes up, that's how you make money. And you're hoping that the market as a whole, or the index that you're tracking, goes up. So those are the three disadvantages of investing in an ETF. I'll be right back right after this. Don't go anywhere. Speaking, I was just talking to you earlier about the contango. And contango is part of the risks of ETF investments. So as with any investment, there is the chance that you will lose money with an ETF, right, folks? We all know that. So if the exchange traded fund drops in value, you could lose some of your principal. Risk specific to ETFs is something called contango. So this risk is especially pronounced with ETFs that rely on futures contract, like commodity ETFs. So if expiring contracts are less expensive than front month contracts, the value of an ETF can drop steeply as the contracts roll over. So when investing in ETFs that involve futures, be careful of this situation. We're actually working on an entire show to explain the contango thing, and this is something that a lot of investors have requested, and we believe we'll just spend a whole show about it. One thing you have to understand, so that's for the risk. The contango is what it is. The delay, the price mismatch in the price mismatch that you have at some point in time. ETFs can help you build up your portfolio. So ETF investments, regardless of the risk that I just spoke about earlier, the cons and also the contango risk, ETF investment can be an excellent way to build a diverse portfolio with relative ease. So over the years, ETFs have become an increasingly popular way to make the most of your money and build a portfolio without the need to invest in individual stocks, folks. As I was telling you earlier, if you want to buy, if you want to have exposure to the S&P 500, you don't have to cash. You can't buy each individual stock in the 500 index. You don't have the cash to buy 500 individual stocks. So it's a lot easier to buy the ETF, the SPY, the Spider ETF, than trying to buy each individual stock in the S&P 500, right? So with an ETF, you get the advantage of the diversity that comes with the mutual fund, as well as the liquidity and ease of trading that comes with a stock. Even better, the costs are low. The costs are pretty low because in a mutual fund, in a traditional mutual fund, they have teams that do research. Those team members do research to pick stocks that will comprise the fund at some point. But you don't have that. You don't have that strategy, that tactic when it comes to an ETF, because all you're doing is just to replicate an index, which means that the costs are low. All right. So this is it, folks. This is it. I just have a conversation with you about how to invest in ETFs, and I will see you next time. Good luck in all your strategies. I spoke to you about what an ETF is, how to invest in an ETF, what to look for in ETF, different types of exchange traded funds, pros and cons of ETF investments, risks of ETF investments, and ETFs can help you build up your portfolio and how they do that actually. All right. Thank you so much for today's conversation. I really appreciate it. I will see you next time. But until then, remember, stay marvelous.